Let's get right to our floor show. I want to bring in right now Claman Capital Management and Fox News contributor Gary Claman, Matson Money founder and Mark Matson. It's great to see you both here. And Gary, I want to start with you because, you know, you've been bearish. I would imagine that the tariff threat and what this is going to do to certain sectors in this economy, in particular autos, has got to be something that's keeping you up at night and giving you more reason to be bearish.
Yeah, and what doubly keeps me up at night is when somebody like Wilbur Ross says tariffs are good. I don't understand where an administration who's basically come out and said one of their great themes going forward is lower taxes, but now they talk about a $6 trillion tax hike going forward. I am in hopes tomorrow less is going to be the story of the day, because I speak to a lot of businesses. There's just a lot of uncertainty. Nobody can price things going forward, plan things going forward. And finally, if they put any tariffs in place, don't change them, because then you'll really drive people up a wall. And I really do believe about 75% of the recent drop is this tariff related. I do think also the economy is a little bit softer. So hopefully we can get past this. And if I never hear the word tariff again in the rest of my life, I'd be a happier person.
Well, and you know what, Mark, I know that you say not to worry about this, but what Gary is referencing is this piece from the Wall Street Journal editorial board that was published last night. And here's what they say: a $6 trillion Trump tax increase. That is because Peter Navarro has been going out and saying this, we're going to get $600 billion. That's going to be brought in. Excuse me, it's going to be $6 trillion over a 10-year period. That's the headline out of Peter Navarro. And I am going to ask Wilbur Ross about that, to be clear, gentlemen, when he joins me in just a little bit. But that is when, if you believe, Mark, that a tariff is a tax, this says this revenue is going to be raised off the backs of consumers and businesses. That's where the money comes from. How can you say that we shouldn't worry about this when CEOs across this country right now and small business owners are very worried?
Yeah. Look, Cheryl, when I talk about this, what I don't mean it in context. Don't worry about it as far as, look, things could be more expensive. It could move us towards a recession. But at the same time, investing is a long-term game, not a short-term game. So when you're looking at the next 10, 20 years, markets already, first of all, markets already know it's coming. We'll know more about it tomorrow, but all the knowable and predictable information is already in the price. Secondly, the markets have already taken a huge hit. I've been telling investors they're under-diversified for the last 10 years now. The NASDAQ is down 16% from its high. Google and NVIDIA are down 26% from their high. And you have to own international. Look, international large stocks, on the other hand, while we're going through this in the United States, they're up to 11% year to date so far. So people have to stay invested. Don't panic. Don't panic over this or anything else for that matter. And you have to buy when prices go lower. Everybody says they want to do it, but it's very hard to do.
I don't think that it's a panic situation, to be clear here, Mark. I don't really agree with that take on it. But Gary, what I do think is happening is, and you know, actually Charles Payne and I were talking about this last week when we were on the news channel together, that you can have multiple reasons for a sell-off. But Gary, you say 60 to 70% of this sell-off we're seeing right now is because of the tariffs. And then you have Goldman Sachs increasing its chances, the chances of a recession. You have Morgan Stanley talking about car prices that are going to be up $3,000, $4,000, $5,000, $6,000. You know, all of those things, along with the University of Michigan consumer sentiment, Gary, which we have seen has been going down. And then you get that ISM number today, manufacturing now, you know, if it's under 50, that's a negative read. That's plenty of data for somebody that's looking at a portfolio to say, you know what, I am a little nervous. I have to make some changes here as we go into what is going to be likely a rough economic environment.
Yeah, look, I'm always hopeful and optimistic about the American people and business here so for down the road. But I'm a big believer in the market. And when you have the semiconductor index at new yearly lows, when you have the transports at new yearly lows, and companies like FedEx and UPS and Norfolk Southern and CSX and all the truckers at new yearly lows, and retail, the retail stocks have been bombed into mostly new yearly lows. I think it's telling you about some issues with the economy. And that's where I say part of this market is the economy. I think it's softer. And the good news is recessions don't happen very often. I think we're going to have a down quarter this quarter, but I think a lot of it's going to be the import-export thing. I'm just worried about, I'm always been hearing about the Republicans are about free markets. And all of a sudden, we're not about free markets, Republicans, because tariffs are basically interfering with the free flow. Yeah. Let me just state for the record, I hope they get it right. I hope they know what they're doing, because I think the market's on edge a little bit here because of all the talk and all the changes, both in product and price and dates. So tomorrow can't get here fast enough, and let's hope that's the end of it.
Yeah, they've been very dismissive, Mark. The administration has, even Caroline Levitt today saying, well, the stock market's going to be fine. She was asked about it during the briefing. But, the truth is, these are 401ks. If someone's pushing retirement right now, they're not liking the numbers that they're seeing. But Mark, I do want to ask you about this, though. We've seen that safety play continue. We've seen it with Bitcoin. We've really seen it with gold. We hit new records again with gold today. But you don't like gold, Mark, at all. Why?
Well, the history on gold is actually very horrendous. Look, on average, gold makes about 5% a year, and it has the volatility of equities. Equities, historically, even large companies average 10%. Small value companies over 14% historically. So gold is a very poor hedge against inflation. It's highly volatile. If you want to protect your portfolio, you should have high quality short-term fixed income, because then if the equities do drop, you can rebalance, selling the short-term fixed income, buying the equities while they're down. And the markets haven't been substantially down for over 5 years now. There's massive gains mixed in for most investors. They become somewhat bulletproof, feel like they're bulletproof, like they're Superman. Look, markets, remember 2008 and 2009, that was a real sell-off. That was 50%. And in 2000, you saw NASDAQ lose over 75%. So look, don't panic, stay diversified. But if you want to protect against volatility, you have to have high quality short-term fixed income, because almost all equities are positively correlated, meaning if markets crash globally, they'll go down.
Yeah, well, and look, markets don't go up in a straight line. The three of us have all worked together now for the last 15 plus years, not to age any of us, but that is the truth. So we know that, this is just kind of a rough patch, and we'll see where the rest of the year goes. That the question mark is, how far does it go? Gary Kaltbaum, Mark Matson. Guys, thank you so much. It's great to see you both. Appreciate it.